Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith Schneider this week for our weekly analysis of the markets. In this Market Outlook, I am going to take a look at whether or not we should be worried about the health of the bull market after Friday's rather significant drop. Actually, I think the news sounded worse than the drop actually really was, but let's take a look at the charts and determine the significance of it rather than be subjective. But before I get started, if you are just finding us on YouTube, please subscribe so you can be sure to get our weekly output, and also check us out at marketgauge.com. So the highlight of this week, if I could call it that, was Friday's action, where if we take a look, I know these charts are a little scrunched up right now, we'll drill into them, but if we take a look at Friday's action on these daily charts, you can see that the SPYs had a rather ugly day to the downside. The magenta line that I'm going over in white here is a 50-day moving average on all our charts. So the SPYs, upper left here, gap down and then traded down below the 50. The Dow, which is the diamonds here in the lower left, looks even uglier, down 1.5%, gapped below the 50-day moving average and continued lower. And the Qs, which I'll make a little easier to see, also gapped below its 50-day moving average and continued to move lower. The IWMs nowhere near the 50-day moving average when it gapped down, but did manage to get down close to the 50 by the low of the day. All of the markets did, however, pull back or recover quite a bit from their lows. That said, IWM's lower left down over 1.5%. The Qs down over 1.5%. The SPYs managed to just eke out a negative 1% gain, which doesn't sound so bad relative to the others, and the dime is also down 1.5%. All right, so the question here is, how significant is this big drop? Well, first of all, the main driver from the news point of view was that it was related to China tightening margin requirements and renewed fears over the possibility of problems with Greece leaving the EU. Additionally, we got some earnings reports that weren't very healthy. Certainly, they weren't taken very well. American Express got clipped for about 4%, I think, on revenues that were light. Right, but as I say in the article leading up to this, the thing that I think we really have to worry about is not the foreign affairs, it's the US, the domestic economy. Right now, I'm not going to get into that in the individual charts, but with that said, let's just take a look at how the US markets are doing. Last week, I focused on global markets, and just to bring that back, one particular chart I want to focus your attention on before we focus on the US is the all world index. This is basically the global stock market index, and this is one I highlighted last week as breaking out and looking good. This is a daily chart, but you can see this is a massive breakout, and all it's done is pull right back to that breakout. So this is definitely an index you want to keep an eye on. This is an ETF you can trade, and if it can hold in here around the 61.5 level, it still looks healthy from my point of view. And in fact, I'd say even if it gets down here to the 61 level, that would still be just a healthy correction back to this trend line area, still above the 50 and within an acceptable fudge factor of the breakout level. So if we use that as a kind of a global proxy for equity markets, they're not all bad. Now, they don't all look that good, but they're not all bad. The US, on the other hand, looks completely different. And the thing that the biggest thing about the US really is the divergence. And I'll highlight that with the IWMs and let's say the Qs. Truth is that I could pick any of the other ones, Dow or SPY, And the issue that I want to bring to light is the divergence between the IWMs, which has been the stronger of the indexes, and the others. So if I get this lined up, close, all right, that's close enough. So in March, or let's say late February, Qs made a high, IWMs made a high. In March, IWMs make a high, but the Qs do not. Then this week, IWMs make another new high, and the Qs do not. Now the Qs are not even close. These are not just a few ticks away from the highs relative to what the IWMs are doing. So this divergence is not healthy. That to me is the biggest technical problem we have with the market right now. Now that doesn't necessarily mean that we have to sell off, but it does mean that the markets certainly aren't all running together. Now, in defense of the Qs, I think 4 out of the 5 top market cap stocks in the NASDAQ 100 are going to report earnings this week. So clearly that could reshape the pattern on the Qs very quickly if they come in just a little bit better than expected. But let's take a look at the individual indexes one by one quickly to get a sense of where the important levels are. I'm going to start with the SPYs. I think there's really only a couple things you have to focus on in the SPYs. And the first is the trend line. I'm actually more focused on how we trade around this trend line that goes all the way back to October of 2014 than we do around the 50-day moving average. All right, so if the 50-day moving average is the magenta line, you can see that we've gone up and down through the 50-day moving average quite a few times. The trend line, however, has really held, and I say that it's held because we've only been able to close below this trend line about 2 times before going back higher. So the concern for the market from a trend point of view for me would come in if we were to close several times below this trend line and then break lower. So until we do that, I think you want to look at the SPYs as really consolidating. I could draw this here and make it look roughly like a wedge, but I think it's probably a better viewpoint to just look at the SPYs as pretty much being in this range. And so Friday didn't feel good, but we basically gapped down, had a 1% down day. It bounced off some support, and we're basically right here in the range. All right, so if your perspective on the markets is that you're worried about moves that would take us down to 205 or back up to 212, 213, then okay, then those are, you're calling those big moves. But if you look at it from this point of view, until we get to either one of these extremes, the market really hasn't done much other than trade within the range that it's defined basically for the year. I think that's the best perspective to have, and to try and look at it as, when we get down to this level, will I want to be a buyer? When we get up to this level, will I want to be a buyer or a seller? All right. Now, how might we figure that out? Well, IWMs have been the strongest of the markets. So as long as the IWMs continue to grind higher, and grind higher would include, staying over this accelerated trend line, but also make note of this trend line that would be the parallel to the one I just showed you in the SPYs going back to October of 2014, comes in below the 50-day moving average. 50-day moving average is positively sloped. It's got IWM should have quite a bit of support on the way down. So again, in order to really look at the market as having really begun to roll over, I think we need to see the IWMs break, try to rally, and then break again. I don't see all that happening in 1 week. That said, if this is the first move of a break, where do you look for that break to land? I don't think anyone should be surprised if IWMs land on this first breakdown down near 122. Put a line at the top, put a line at 122, and I think that's your range you want to watch out for big picture in the IWMs. Again, if a move to either end of those ranges is one that you see as significant, okay, then that's a different perspective than this big picture that I think is the one you should focus on. Not to say can't trade more actively than that, but the media is going to get into such a frenzy if the markets go down another percent, another 2%, right? But we got to look to see where that falls within the bigger ranges. In the case of the Qs, if we come down another 2 points, which is another 2%, we're just going to be back down to the bottom, roughly to the bottom of this range. And that is the range you should look at in terms of the Qs. So after this week, when we've got big earnings reports done on the Qs, I have no idea where the Qs will land after this. But the next big direction in the Qs will probably be determined by which way we break out of this particular range. Now, as the markets move to either ends of these ranges, I think you really want to pay attention to the TLTs, all right, interest rates. Of course, people are focused on when interest rates are going to go up. Everybody's focused on when the Fed is going to start to hike rates. Until recently, there was talk about strengthening economy. So that would also tend to put pressure on rates going up, which would mean TLTs going down. But when I look at the TLT chart here, I don't see something that is necessarily ready to go down. This, again, if I like to identify the major ranges, it would be right here. Whichever way this thing goes, it's probably going to continue. Considering that Germany and many of the European nations have negative rates in parts of their curve, and even with the 10 years, they're not quite down to negative, but the US rates are relatively high already compared to most of the world. So when you think there isn't any room for US rates to go down, there certainly could be. I'm not saying that it's a good thing, but don't discount a rally in TLTs. Now, if we get a rally in TLTs, and yesterday I think is somewhat of an example of this. Yesterday you can see TLTs, or Friday TLTs were strong, markets were stocks were weak. That's the kind of action that we really don't want to see for stocks. All right, so if you've got TLTs really pushing higher and stocks pushing lower, that implies that stocks are fearful. People are dumping stocks and running to the TLTs for safety. All right, so that relationship, I've said this before, is the one that I look at as being most bearish for stocks. Therefore, if you're in the camp that stocks have plenty of room to fall, then TLTs, good chance, have some room to run, even if it's just for a short-term pop with a flight to safety. All right, so I think this is a really interesting pattern in TLTs that should the momentum continue higher, you've got enough consolidation here to take this higher. Does it go all the way up to the highs up here? I don't know, but it certainly has traded very technically to this point. All right, so the one thing that doesn't make a whole lot of sense, but I think I'm probably looking at too much of a nuance here, is you got a really strong day in TLTs, got a really weak day in the SPYs and the stocks. That does make sense. But the one thing that doesn't really make sense, and maybe I am just being a little too nitpicky here, is what happened with the VIX on Friday. Okay, so my point here is SPYs sold off pretty hard. Now they bounced back to only be down 1%. TLTs rallied and closed at the highs. VIX did rally, which would be consistent with everything else that we're seeing, but then closed near the low of the day. And so if there really was as much fear in the market as the drop in the SPYs might suggest and the rise in the TLTs might suggest, then why didn't the VIX stay strong right up to the end of the day? Again, maybe I'm being looking at this a little too closely, but the other place to look here is to watch the VIX. And actually, if you want to short the SPYs, you may have a better bet being long the VIX, only because if the SPYs do start to decline and the momentum on the downside tends to pick up, it's not going to be a really big move in the SPYs to just come down here. But if the SPYs get down to the 202 level, you could expect that the VIX is going to have a much bigger percentage move up. So from a leverage perspective, the VIX would be a more interesting way to play the short than just to short the SPY. A little bit of a tangent there, but FYI. So last week, speaking of the VIX, there was one indicator that I said to focus on, or wanted to focus your attention on, that might have suggested that the markets were a little extended to the upside, and that was the VIX against the Bollinger Band. As we look at it, it was right here. When this happens, markets tend to take a rest, sometimes sell off. Now, it took all week to kind of rest and the end of the week to sell off. I'm not going to say that this predicted the sell-off, but it definitely was a good indication that the markets might need to take a rest. But that's about done for now. There isn't really a whole lot here to get me excited to give us any insight. For me, doesn't really give me any real insight into what might happen this week. And truthfully, that's kind of how I feel about a lot of our internal indicators right now. So the McClellan, for example, I see this as just pretty much in the middle of nowhere. If it was oversold and the market was getting weak at a high, then I would see it as negative. If it was overbought, the market's still relatively close to the high, then it would be a negative. Sitting right here in the middle, I don't get any real sense of conviction that it's going to help me figure out which way the markets are going to go. In terms of new highs, new lows, it's pretty much the same situation on the New York as well as the NASDAQ. The ratio is into the 90s, which is still very bullish. We look for it to come below 70 to turn bearish. The number of new highs here is relatively weak, but that said, again, it's not glaring. If we continue to move in this direction and the new lows pick up and you have the new highs cross lower than that, look, it's negative. It's not what we want to see for sure, but is it anything that's going to make me change my posture of saying this is really what you need to look at, and anything in here is essentially noise or really short-term trading. So I could go into more detail on the advanced declines or new high, new low analysis, but really I think that sums it up. I don't think there's anything hugely compelling in terms of an indication of what might happen next. So let's just take a look at a couple of markets that are interesting within the US. I'm going to say in no particular order, let's just take a look at energy first, which seems to be an area that has shown some strength. Let's start with the USO, the crude oil ETF. This, I need to point out, is right up against a key resistance level, prior support level. So if we take a look at the big range here, a move back to the 50 would bring us back to 18. And that would be a pretty healthy correction. Breakout here would really make things interesting, although it seems like it could be a bit extended at this point. But I don't have great reasons to suggest that it's extended, other than it's had a pretty nice move off the low. So it's a commodity. One thing about commodities is they do tend to go way beyond people's expectations, as I think crude has already demonstrated it's perfectly capable of doing. But in other words, Crude or USO between 18 and basically 20 would be a good range to look out for. With that in mind, OIH has already broken out. Okay, so this looks like a really nice looking bottom longer term. Sorry, that's a rough line. I wanted to draw it across here. So a pullback a little further, as you can see, would bring you to the 10, which is the green line, and you can see that lines up rather nicely with prior highs and prior support. So I would look for how the market trades when it gets back to that 36.50 level, and even now with this strong break above the 50, a pullback to the 50 would be a really natural place to look for an opportunity there on the long side as well. Another area that's interesting on the long side is the home construction. Now, the housing data this week really wasn't all that great, but if we look at the weekly chart here, this thing is, give you a little bit more perspective, this thing's breaking out of a massive 2-year consolidation. That high of that 2-year consolidation is around 2650. Again, we're on a weekly chart. So you can see we did break out of the 2650 initially and reverse. This was on bad earnings in a particular company. I don't remember the exact one. Then we broke out nicely, pulled right back to the breakout, broke out again, pulled back. Now keep in mind, these breakouts have been happening when the SPYs haven't been making the new highs. ITB has been making new highs. So long as the SPYs and the general market holds up, ITB I think is a place to look. Didn't look good on Friday, but in the context of what I just showed you on the weekly, whether today, or I should say Friday, is the last day down, I don't know. But if the market stabilizes and turns higher, this is definitely a place to look. Another one would be IBB, biotech. Now, it looks as though this could be a blow off top up here. For sure, that action is a bit frightening. That said, if it's not, this thing has bounced nicely off the 50 and for all intents and purposes held up really well on Friday in terms of it bouncing back. So you'll notice if you look at quite a few of the charts that the markets did come back, and so the market's coming back to close middle of the range, sometimes upper end of the range, with that VIX also closing almost near the lows of its day, do suggest that maybe the market just got spooked by international news. And most of the time recently, when the markets have been spooked by something international, it's been a very short-lived sell-off. What we need to be concerned with or focused on is whether or not the market really starts to focus on weakening U.S. economic conditions and sells off on that. If that happens, that's when I think you need to get concerned of any break below the lower end of the ranges that I've pointed out. So until next time, I hope that helps, and I'll see you in the next video.